What I'm about to show you proves that the silver shortage has reached a breaking point. Right now, silver is trading around $90 per ounce, but here is what they are not telling you on mainstream financial news. APMEX said unprecedented order volumes tied to repeated record highs in gold and silver have pushed operational capacity to the point that it is instituting a $10,000 minimum order to help keep volumes down and improve service levels, alongside broader fulfillment and product availability controls. A $10,000 minimum order. Let that sink in. APMEX is a precious metals dealer that has been in business for over 15 years and during that time has sold over 130 million ounces of gold and silver. And they have never done anything like this before. We are experiencing volumes that we have not seen in our history. This past weekend alone, order volume reached nearly 7 times that of a normal weekend. 7 times normal volume in one weekend. The largest dealer in America cannot keep up. If you own silver, you need to understand what this means. If you are trying to buy silver, you need to understand why finding physical metal is becoming nearly impossible. Something has broken, and by the end of this video, you will understand exactly what it is. Welcome to AG Profit Hub. This is where we cut through the noise and expose what is really happening in precious metals markets, while everyone else feeds you the official narrative. Subscribe right now and hit that notification bell because this situation is evolving daily. If you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see the truth. And trust me, what I am about to reveal is something the mainstream financial media refuses to cover. Let me walk you through exactly what APMEX just announced because this is unprecedented in the history of precious metals retail. In a customer letter, CEO Ken Lewis described the last 2 weeks as historic, citing multiple record highs for both metals and a surge in demand unlike anything we've seen in years, driven by global uncertainty, inflation concerns, and renewed interest in hard assets, with inflows from both new customers and returning investors adjusting positions. Unlike anything in years, that is the CEO of America's largest precious metals dealer telling you directly that demand has never been this intense. This level of demand brings real challenges across the entire industry. Supply is tight, order volumes are elevated, and service channels are under pressure. Many firms are struggling to keep pace. Now here is what they had to do to survive this demand surge. Also, to restore availability, APMEX said its minting teams have narrowed focus to 31 core production silver products. They cut their product line down to just 31 items. Think about what that means. A company known for having thousands of options is now focusing on just 31 products because they cannot keep up. As of the letter date, APMEX reported 21 of the 31 were in stock, up from sub-15 a few days ago, and said it expects the majority to be in stock by this weekend, conditional on demand not increasing further. APMEX added that it has turned the majority of pre-sales off, keeping pre-sales only when it believes it can ship the product within 2 weeks. On the retail purchasing side, APMEX said it is currently 4 days behind in receiving customer orders. 4 days behind. Pre-sales turned off, product lines slashed, and still they could not keep up. So they did the unthinkable. In response, the firm instituted the $10,000 minimum specifically to reduce incoming volume and improve service levels. The firm also noted that it increased sales and customer service headcount by 25%, reallocating staff across the organization as it anticipates longer hold times and higher contact volumes during fast-moving markets. They increased staff by 25% and still could not handle the demand, so they had to turn away small buyers entirely. Now let me show you that this is not just APMEX. This is happening across the entire industry. This follows United States Mint warning customers earlier it may temporarily remove silver coins from sale as it evaluates pricing adjustments hours before silver hit a record high above $90 per ounce. The U.S. Mint, the official government mint of the United States of America, removing products from sale because they cannot keep up. The Royal Canadian Mint and Perth Mint are both out of key products. SD Bullion had fewer than 2,300 units left at last count. And Costco? 0 silver or gold at any Ontario location. 0. Costco has no silver or gold available in entire regions. Global mints, refiners, and dealers are running out of physical silver as demand overwhelms supply. From Canada to Vietnam, inventories have vanished and even raw materials for minting new bars are drying up. Even the raw materials are running out. The mints cannot get the silver they need to make the coins. TD Precious Metals is having its own issues. Their retail site has crashed at least twice in recent days. Given that their inventory and listings continue to sell out, read into that what you will. Websites crashing, inventory selling out instantly. This is not normal market behavior. This is panic buying meeting a supply brick wall. And here is what is happening to the actual metal supply. This has led to regional dislocations, shipping delays, and silver being vacuumed from the exchanges to be stockpiled in American vaults. Lease rates jumped, temporarily increasing over 30x from normal levels during periods of acute stress. At the same time, the silver market has been in a supply deficit for the past 6 years, and above-ground stocks are beginning to deplete. 30 times normal lease rates, 6 consecutive years of deficit, above-ground stocks depleting. Now let me show you what is happening around the world, because this is where the evidence becomes undeniable. On January 1st, 2026, while COMEX silver futures showed $72 per ounce, physical bullion dealers in Japan, UAE were selling, when they could find inventory, at $130 per ounce. Let me repeat that. An 80% premium for physical silver over the official spot price. This has never happened before in modern markets. An 80% premium. The paper price says $72. The physical price says $130. Which one is telling you the truth? While paper silver was crashing in New York and London, physical silver in Shanghai was trading at premiums exceeding 50% over the COMEX price at the crash low. Even during the crash, physical premiums exploded. The widening of physical premiums during a paper crash is the signature of something else entirely. It is the signature of a market that has fractured into 2 separate pricing regimes that no longer communicate with each other. The paper market and the physical market have divorced, and the implications of that divorce will define precious metals investing for the next decade. And the vault data confirms the crisis. According to recent data from the London Bullion Market Association, LBMA, total silver holdings have fallen nearly 40% since 2021, marking one of the steepest declines on record. This also demonstrates that this supply squeeze has been coiling for some time to create today's explosive movement. 40% decline since 2021. The vaults are being drained systematically. The Silver Institute reports that since 2019, more than 1.1 billion ounces have been drawn from available mobile inventory to satisfy both industrial demand and ETP backing requirements. That is metal that was readily accessible for trading and lending that is now locked up in various forms. 1.1 billion ounces, gone from accessible inventory, never to return. Now let me explain why this shortage cannot be fixed quickly, because this is the critical insight. Roughly 70–80% of the world's silver supply is produced as a byproduct of mining for copper, lead, and zinc. Dedicated silver mines are rare. As a result, production cannot quickly increase when demand rises or prices spike. New mines take time. It often requires 7 to 15 years to move from discovery to meaningful output. At the same time, many existing mines are dealing with lower quality ore and rising operating costs. 7 to 15 years to bring a new mine online. The industry cannot respond quickly even if they wanted to. For years, above-ground stockpiles helped balance the market. That buffer is now gone. From 2021 through 2025, global silver inventories declined year after year, creating cumulative shortages approaching 820 million ounces. Early projections for 2026 suggest another shortfall of 150–200 million ounces or more, 820 million ounces of cumulative shortage, and another 150–200 million this year. And the mint and refiner system is breaking down. Most mints and refiners don't hold vast stockpiles of silver. Instead, they lease the metal from bullion banks, refine or mint it, and then repay the borrowed silver once new supply arrives. With lease rates now sky high, the economics of this system are breaking down. For some refiners, borrowing silver has become uneconomical or even unviable, forcing them to prioritize core products and delay less profitable lines. The entire production system is based on leasing silver at low rates, When lease rates explode, the system stops working. In years of ample supply, 1-month silver lease rates typically sit around 0.3% to 0.5%. By January 2026, this rate had exploded to around 8%. Because the market is short of silver to a clearly abnormal degree, from 0.3% to 8%. That is not a normal market fluctuation. That is a system screaming that there is no silver. When someone is willing to pay 8% annualized just to borrow silver so they can be sure to take delivery on time, that in itself is a signal. Physical supply and demand are severely out of balance. Under normal conditions, no rational borrower would accept such an expensive cost of borrowing. These elevated lease rates almost completely crush cross-market arbitrage opportunities. Now let me tell you what this means for you, because understanding the situation is useless if you do not know how to act on it. For savers and investors, the implications are clear. Physical ownership is non-negotiable. Counterparty risk for paper silver is higher than ever. In a fragmented market where physical metal increasingly dictates price, relying on paper claims introduces risks that many investors have not fully considered. If you are holding physical silver, understand what you have. You are holding one of the scarcest assets on the planet right now. Gold, silver, and platinum continue to set record highs, hitting levels many of us could not have imagined in such a short period of time. We are experiencing volumes that we have not seen in our history. If you are trying to buy, understand the new reality. If you are buying physical silver for long-term holdings, paper price pullbacks driven by margin-induced liquidation can offer attractive entry points because the underlying physical market remains tight. Physical premiums over spot prices reflect real supply chain constraints rather than artificial manipulation. Pullbacks are no longer triggering exits. They're being used as allocation opportunities, signaling durable investor confidence. The widening paper versus physical divide matters more than ever, as futures pricing increasingly reflects leverage unwinds while physical silver remains scarce. The smart money is buying every dip. They understand that the paper price is noise and the physical shortage is the signal. Let me leave you with this. In an effort not to sound like a record on repeat, markets continue to accelerate. Gold, silver, and platinum continue to set record highs, hitting levels many of us could not have imagined in such a short period of time. We are experiencing volumes that we have not seen in our history. APMEX just implemented a $10,000 minimum order. They increased staff by 25% and still could not keep up. They cut their product line to 31 items. They turned off pre-sales. They are 4 days behind on receiving customer orders. The U.S. Mint is removing products. The Royal Canadian Mint is out of stock. Perth Mint is out of stock. SD Bullion has almost no inventory. Costco has zero silver in entire regions. With industrial demand accelerating, monetary pressures intensifying, and physical supply constrained, silver's repricing may still be in its early stages. Many now view prices above USD 100 per ounce in 2026 as increasingly plausible, not as speculation, but as a consequence of structural realities. It is no longer simply a leveraged proxy for gold. It is increasingly viewed as a critical industrial commodity tied to supply chain resilience, defense technology, and electrification. In this context, silver looks less like a trade and more like a strategic allocation. Markets are pricing access and reliability alongside scarcity, reflecting a shift toward valuing control of real-world supply, rather than financial exposure alone. APMEX just did something unprecedented. They had to turn away small buyers because demand has overwhelmed the entire system. The shortage is not getting better. It is getting worse. Drop a comment telling me if you have experienced delays or out-of-stock notices when trying to buy silver. I read every single comment. Subscribe if you have not already. Hit that notification bell because this story is far from over. The largest dealer in America just raised the white flag. And now you understand why. This is AG Profit Hub, because the real story is never on the surface. I will see you in the next one.